Hello everyone. Can we all hear me? Good afternoon. Hello, can we all hear me? Please, can someone confirm that you can hear me? Good afternoon. Can we hear me? Please, if you can hear me, please indicate by raise of hand or use of emoji, right, so that I'm aware that we can all hear me. All right. So I don't know why. It seems I can't really hear you guys. Okay. Mm, all right. Good afternoon, everyone. Thank you all for joining in for today's class or for today's session. Please, would like to kindly ask that we try as much as possible to um, send in the link to our subgroup so that we can have more people joining. The class is quite scanty, so please let's try and do that so that we can have quite a number of people on the call. Thank you. We'll be starting right about now. It's already time for it's already time for the session. Just give me a moment. I'm coming. All right. Sorry about that. Welcome to class. Welcome to week one of the JIIPCC Mentorship and Internship program. For the JIIPCC Mentorship and Internship program, my name is Dennis Williams, and I will be helping to moderate these sessions today. So we will not be wasting any time. We will not be wasting any time, and we will be getting straight into the business of the day. Right. So what our agenda is going to look like today is that we're going to be having presentations from our mentors that we expect to be on call. We are going to have presentations from mentees. So please, group one and group two presenters, please do well to get ready because we'll be taking presentation from you all, or we'll be taking presentations from both groups, right? And then we would have feedback from the mentors. We'll take questions, and then we will call it a day, right? We'll call it a day. So I will just go ahead with starting to introduce the mentors that we're expecting into this class. First and foremost, one of the mentors that we're expecting in today's session is Mr. Max Ikombe. Mr. Max Ikombe is the founder slash principal of Everlaw Associates. He works extensively in the field of arbitration, ICT slash technology law, and intellectual property. Max is a facilitator on the annual Information Technology and the Law course of the Nigerian Institute of Advanced Legal Studies since 2016. He has trained in advanced intellectual property law courses at the World Intellectual Property Organization and has and he is an accredited agent of the Nigerian Trademark and Patent Registry and has conducted IP registration business there since 2010. All right, so Mr. Marks is going to be our first mentor for today. He's not yet here on the call, but I hope he'll be joining us soon. Secondly, we're expecting into this class is Mr. Peter Cole Onele. Mr. Peter Cole is a legal associate with Nigeria's premier corporate commercial law firm, Chris Ogumbanjo LP. He provides cutting-edge legal expertise at the intersection between law, technology, intellectual property, and finance. His professional legal expertise centers on novel areas of law, including technology law, intellectual property, and AI, and fintech advisory. He also provides strategic legal counsel to early-stage, emerging, and high-growth startup ventures founders and their founders, whether private equity, or angel investors. He is a member of a select professional body, including the International Bar Association, International Technology Law Association, Fintech Association of Nigeria, and Young International Chambers of Commerce, Shal Arbitration, and the Startup Legal Global Institute. Before pursuing a full-time career in legal practice and advisory, Peter Cole co-founded/led impact startups and social impact initiatives, winning awards for innovation and social enterprise. He is a fellow of the Savvy Fellowship, the 0 to 1 High Impact Fellowship, an ambassador with the World Literacy Foundation, and an alumni of the HOTS Prize Global Enterprise Challenge. So, Mr. Peter Cole, we're expecting Mr. Peter Cole in today's class. Last but not least, of the mentors we are expecting in this session for today is Mr. George Onyewuchi. Mr. George Onyewuchi is currently heads fintech engagements for First Bank and its subsidiaries across Africa at the Digital Innovation Lab, setting up and driving the bank's fintech strategy. George is a link that connects technology, business, and ecosystem partnership. He is at the intersection of product partnership and ecosystem building. He has led the tech solution product developments for the SME banking business of a leading commercial bank, and has taken numerous financial and non-financial products from ideas to markets and growth. He has led digital transformation in the client's engagement processes for leading commercial bank, including one of Nigerian banking industry first end-to-end account opening for corporate accounts and SME digital lending. His team has won numerous awards for powering growth of SMEs. He also provides advisory for Cryptos Africa towards developing blockchain infrastructure and building the operating system for African businesses on the blockchain, and hosts knowledge sessions on blockchain application to various industry within the African continent. So Mr. George will be our last mentor under the fintech under the class for today, right? So we'll be awaiting their presence because we don't have any of them yet on call, right? We hope that they'll be joining us shortly. We are trying to reach out to them to make sure that we have them in class. But not to worry, prior to them joining in, right? Prior to them joining in, we'll be making headways, and in doing that, one of the things that we're going to be doing in today's class is that we're going to be taking presentations from mentees. So we're going to be taking presentations from mentees. So we have two groups that have prepared their presentations. You all have worked in groups to prepare your presentation. and we would like to just in today's class listen to you discuss your slides. That is the group presenter, discuss your slides, what you have researched, and we have sent your presentations to the mentors, so they have an overview of what you guys are going to be. They have an overview of what you are going to be presenting in the session today, so they'll be giving comments to it later on. So not to waste any time, seeing that we're already in session, please let us start with presentations. So if we have the presenter for group one in class today, can we kindly have presentations?
Good afternoon. My name is Alice and I'm the presenter for Group 1. I'm going to try to share my screen now before I start.
All right, please go ahead, Alice. Sophia, are you with us? Okay.
Okay, so can everyone hear me?
Yes, we can hear you.
Okay, good afternoon, everyone. So my name is Alice and I'm representing Group 1 and I'm going to be presenting our topic on, making our presentation on the topic legal development of fintech. Now, to properly discuss this topic, we talked about different areas to give more context to fintech, the legal development of fintech. So this included talking about the origin of fintech, talking about the evolution of fintech, the legal framework, including regulations in Nigeria, some challenges that we noticed in the course of our research, as well as opportunities and prospects that we recommended and solutions that we recommended. So firstly, I'm going to be talking about the aspect of the origin of fintech. So we all know that there are traditional banking institutions globally in Nigeria, but right now in Nigeria, and most of these traditional institutions were found to have been to have caused inconvenience in some aspects, as well as not forward thinking with regards to global transactions and innovations. And this was one of the reasons that a number of fintechs came up, not just in Nigeria, but also globally. So with regards to the origin, fintech online banking emerged in the United States in the late 1990s, and this sort of signified the start of a new era of exploring financial services outside of the traditional banking system. Now, to just cast our minds to what fintech means financial technology. And what this means is making use of technology to properly aid some services that exist within the financial sector. So in Nigeria, one thing that we recognized in the course of our research was that the 2012 cashless policy period was one of the propounders of the switch, not total switch, because these traditional banking institutions are still being used, but the switch and the forward looking at some of these fintech services that were being provided. And this cashless policy was characterized by individuals not being able to withdraw more than a certain amount, 50,000 as is stated in our slides, and corporates not being able to withdraw no more than 300,000. However, some of these people that created some of these innovators who came up with this fintech services that we're still going to talk about later, sort of use this as a loophole to properly introduce their services to a number of people, and that was when more eyes were cast on the fintech sector. The evolution of fintech in Nigeria is also something that we discuss in our slides. As mentioned earlier, traditional banking was characterized by the lack of access, lack of innovation, and there was no financial inclusion, especially for those who wanted to undertake transactions globally and those who were limited in either time or in finances with regards to making transactions even within the country. And fintech goes beyond just sending money. As we're going to talk about a number of fintech innovations, but it also includes financial management. It also includes saving and investing. And with traditional institutions, the options were limited and people could only do so much as provided by these traditional institutions. However, with the introduction of these services, people looked at banking and finance with a new pair of lenses. So fintech basically led to financial inclusion, which is what we're going to highlight in our group today. It led to it encouraged, not led to, but it encouraged financial inclusion. It encouraged innovation. And some of the notable players that we stated in our slides include Paga, eTransact, Mkudi, T-EasyPay, and a number. We also mentioned that there is also the Kenya's M-Pesa mobile money model. So I'm going to just go over to our legal framework of fintech, which is the core of the presentation today. So we try to look at this framework from the aspect of the existing regulators as well as the laws of relevant laws or provisions that existed. And with regards to the laws that exist, we mentioned a number of laws as we can see in our slides. We mentioned CAMA. With CAMA, what is relevant there is that CAMA provides the requirements for the creation and the establishment of companies, the number of people that can form a company, the with regards to PLC, with regards to private companies and things like that. And so that's why we believe that CAMA is relevant, because it sort of sets a foundation for innovators who wanted to create these these fintech companies. We also mentioned the AML and Terrorism Act. As fintech continues to grow, we find that money laundering, financing of terrorism are becoming more and more common, because there are certain loopholes, which of course fintech is adapting to try to address, but there are some loopholes that a number of people with not so good intentions are taking advantage of and are therefore using it to scam people of their money, using it to take people's money and things like that, as we commonly see. I mean, there are some people that get phone calls from different people about their BVN online or things like that. And that takes me to the NDPR 2019, which basically covers data protection. With fintech, it is important for these innovators to ensure that the information of their customers, of those who use their services, are protected. And that's why we found it important to highlight that as much as some of these services are now conducted online, there is still a requirement and a compliance mechanism still needed to be put in place by some of these innovators to ensure that the information of their customers and those using their services are not exposed or used for any use that has not been consented to by the users. We also mentioned the SEC. That's the Security and Exchange Commission, and basically they make provisions as a number of things, mostly relevant to compliance, that these fintech innovators need to comply with. We highlighted crowdfunding, we highlighted virtual assets because they're very much relevant, especially in today's time. We also mentioned other kinds of laws and frameworks. We mentioned the Cyber Crimes Act. As I mentioned, this ties to people taking advantage of other people's resources, other people's money, and cybercrime has to do with crime that are conducted that are conducted online, basically, just for in layman's language. Moving on, we spoke about the challenges of fintech in Nigeria. In as much as there's financial inclusion, in as much as there's innovation, there's also the problem that there are certain angles of fintech that is being taken advantage of, and that's what we try to highlight. Firstly, as we can see in the slide, we spoke about the lack of unified regulation. I mentioned a number of regulators, a number of frameworks. I forgot to mention the regulators. As it stated in our slide, there's the EFCC, there's the CAC, there's the SEC, there's the NCC, NDIC, and things like that. They all are tied to some of the frameworks that I mentioned. So aside from that, there's a lack of unified regulation in the fact that there are a number of compliance mechanisms, there are a number of requirements of these financial services that sort of can overlap and at the end of the day defeats the purpose that some of these regulations might have been created for. And it creates a burden because we're trying to be forward looking, we're trying to adapt to technology, we're trying to build a system and an atmosphere where people can make transactions, can use their resources in diverse ways in such a way that does not defeat the purpose of what we're trying to do. I hope you understand that, and I hope we're following. Also, we also spoke about the older population's distrust in this system. I would just like to give an example. With a lot of petty traders, some of them found it hard to convert in quotes, to convert to fintech services, for instance, like OPay or Kuda, because they couldn't trust that it was just an easy system for them to put their information online. Their money should just be there and they should be able to send it like that. Like, they could not come to terms with the fact that financial transactions could be as easy as that without them having to go meet someone face to face, say what they want, and then the person will respond to them. So things like that cause a distrust in the system. We're still going to look at some of the recommendations that we gave. But moving on, there are also cybersecurity risks. There's the risk of money laundering, like I mentioned earlier, where people can, place money, layer them, and then try to integrate it into the system. So there's the issue of financing terrorism, where people use even money that are gotten from legal sources, but to finance illegal things like terrorism. Money laundering is money gotten from illegal sources and then layered in such a way that the sources cannot be traced to the illegal means that it was gotten. There's also the issue of fraud that we mentioned. Then there are tech failures. Because most of these transactions are conducted online or through a number of services that are prominently online, there might be the occurrence of unauthorized transactions and things like that. And just to mention, there are a number of fintech aspects. There's the aspect of saving and investing. For example, we have Cowrywise, we have Piggyvest that do that. There's the aspect of sending and receive money. We have OPay. There's also the aspect of some fintech services that provide financial management. So fintech is sort of diverse, and it is easy for there to be some loopholes and financial transaction failures that can rid people of either their time and their money. We also mentioned that there might be a digital divide. There might be a system of inequality, and this now takes me to the opportunities and the prospects that we observed in the course of our research. One of the things that we observed is that there's a youthful and a savvy population and a tech-savvy population, sorry. And this is very important because, as I mentioned earlier, technology is evolving, and with the inclusion of youths who are more knowledgeable about some of these technological changes and innovations, this would propagate the benefits and the need for fintech to be, included in our day-to-day activities. Also, we mentioned that the rise of fintech services allows other subsectors to also shine. For example, as seen on our slide, there's the regulatory compliance automation. And there are a number of them in Nigeria, like RegFile and RegCompass. There are a number of them. So these businesses, for instance, allow the automation of some regulatory compliance requirements that might be needed. And so things like doing KYC, things like doing know your customer, know your business, and just vetting things like that can be automated. So there's a growth in the economy just like that. So fintech allows a growth in not just the fintech sector, but also for other subsectors. In addition to that, we mentioned that we highlighted that one of the benefits and the major benefits of fintech services, especially in Nigeria, is the financial inclusion, innovation, the economical growth. And this is something that we cannot trade just because we do not want to take the risk, in quotes. In conclusion, this presentation was just highlights, how fintech originated, some of the starting companies that brought that properly propagated fintech in Nigeria. We also highlighted some of the legal and regulatory frameworks that exist to curb and to curb some financial crimes and to regulate the use of fintech in Nigeria. We mentioned that there are some problems, but it's also important to highlight that there are relevant solutions. One of the things that we call for is that, some of the innovators of these fintech services should be more forward-looking by involving more growing technology into their system, and also ensuring that the goal, financial inclusion, should not be discarded or cast to the side. And it is also important that they collaborate with relevant stakeholders, for example, like the regulatory compliance companies, RegTech companies that I mentioned. They collaborate with them to ensure that, as much as innovation is being created, people do not do so at the expense of their own time and their own money. So despite any challenges that fintech might be experiencing, or prospects of challenges that they might experience in future, there is a chance and there's an opportunity to avoid some of these issues. Thank you. That's the end for group 1 presentation.
All right, thank you very much, Alice, for your very wonderful presentation. We are happy that you were able to share your thoughts with us and everything that your group was able to research. Well done to you and your team for putting it together. Well done to you and your team for putting it together. We'll be going on to have Group 2's presentation. Please, Group 2 members, you can kindly start your presentation. And then after your presentation, we'll take presentations or our discourse from the mentors. They will give insights into what you have shared, and also give insights into what you have shared, and also answer questions. And that will be that for class. So please, can we have presentation for Group 2?
Good afternoon, everybody. Can you guys hear me?
Yes, we can hear you.
Good afternoon. My name is Senator and I'm the presenter for Group 2. Let me go ahead and share my screen.
All right, please go ahead.
So we'll be talking about the fintech industry, the talent needed by fintech companies, and what they should consider legally before hiring talents. So to begin with, we know that fintech company is a company that combines technology and finance to deliver financial services. Fintech is not just about technology or finance alone. It's about bringing these two worlds together so that you can make financial money management faster, safer, more accessible, and all that. So to succeed, companies need people with diverse skills. And while hiring these people with diverse skills, they must also make sure that they should take note of their legal responsibilities. When the talent needed is technology proficiency. And it's no surprise that fintech needs technology, because fintech is built on technology. So behind every smooth mobile app or payment system, They are still developers and architects, those people who design and maintain these platforms. So basically, without their technical expertise, the solutions we see today on payment apps and all these things will not exist. So the second talent needed by fintech companies is data analysis and visualization. So every data plays a massive role in fintech because every transaction, every market trend generates information. So they need professionals who can interpret this data, whether through analysis or prediction, so that they can give the fintech companies insight into the decisions they will make to serve their customers better. So the third talent fintech companies need is cybersecurity, and this is an indispensable part of fintech companies because nobody will trust a fintech platform if their money and personal details are not safe. So this is why they are very important. They help build protective walls around digital assets. They will spot any hack early, and they can help the fintech company to withstand attacks. In short, they just like keep this fintech company safe. So the fourth talent led by fintech company is financial intelligence. So fintech is not just about the technology. While fintech is still about technology, it's still about finance. So it means that knowledge of investments, the risk management, market trends, and all that is still important. So they need fintech companies professionals with financial expertise to make sure that their products are reliable. Then the next talent needed by fintech company is legal and compliance rules. This is because fintech is one of the most heavily regulated industry out there. Legal professionals will help companies to navigate this complex regulated environment. They will help draft contracts, handle compliance, and make sure that everything done by the company stays within the law. Without this, any mistake they make can, let me say, bring the company down. Then fintech companies also need user experience, user-centered design and product management, according to sorry, to the next slide. Yes. Um, behind even the most advanced fintech app cannot succeed if the people using it don't find it attractive. So this is why they need UX designers, UI designers to ensure that these platforms are appealing and they're tailored to attract customers. The next talent needed is problem solving and adaptability. So this this means that because the fintech industry is moving at a very high pace, so new rules are coming in, consumers change their preferences, and technology keeps evolving. So they need problem solving skills, and they need the ability to adapt so that they will not be left behind. So companies need members who can think quickly, stay calm under pressure, and still find and come up with effective solutions quickly. So the last talent needed by fintech companies is the marketing and brand visibility. Of course, like every best product still needs visibility because without advertising your product, nobody will know it exists. So fintech marketers help shape the brand image. They help users to understand how these platforms can actually help them financially. Because if they don't market their fintech products, their innovations could remain invisible. So we'll then move to the legal responsibilities to be considered by fintech companies when they are hiring talents. And to begin with, we have clear and compliant employment contracts, which is that every every new hire, every new employee should have a well spelled out compliance employment contract that will let him know the duties, his pays, his terms, and everything. So that this will help them to avoid confusion and it will keep the company safe. So next we have pension and tax obligations. Tax deductions and obligations cannot be ignored in Nigeria. In Nigeria, we have fintech. Moreover, in Nigeria, firms with 15 or more employees contribute to pension and register for proper tax remittances. And meeting this obligation shows that they're professional and they're complying with the laws. So moving on to the next slide, we have that fintech companies should ensure a discrimination-free workplace, which is that they should not they should ensure fairness because they should not discriminate anybody based on gender, religion, disability, ethnicity, and all that. A fintech company should embrace fairness so that they will not go against the provisions of the Nigerian Constitution and human rights. So we have the next legal consideration is health, safety, and work environment. This is a very important aspect because whether any type of setup, whether physical or digital, the companies must protect their employees' well-being. They should make sure that their employees' well-being is of paramount um, interest. Okay. Then the next is data privacy and confidentiality, which is that fintech deals with heavy customer data. So they must make sure that these sensitive data are kept. So it means that the staff, employees should be trained on protection rules, and that contracts should also include confidentiality clauses to avoid breaches. Then next, we have licensing and regulatory compliances. This is that when hiring compliance officers, fintech bodies must secure their licenses from regulatory bodies like the Central Bank of Nigeria or the Security and Exchange Service Commission. Then next, we have work authorization and immigration compliance. If they are hiring foreign talent, fintech companies must make sure that they abide to immigration law, social protection laws, which is that their intellectual property rights and innovations must be protected, even when employees, let me say an employee leaves the country, leaves the company. Intellectual property will help protect their innovations so that they will not lose their innovations. Okay. Then we have non-disclosure and non-compete agreements, which is that in a competitive edge, they need to safeguard their safe and their sensitive information. Many fintech firms adopt these non-disclosure agreements where reasonable. They also adapt non-compete clauses to prevent employees from leaking sensitive business information. Then lastly, we have the insurance policies, which is that fintech companies should also make sure that they take out specialized insurance policies such as cyber risks or liability coverage to ensure resilience.
The other Scots on TikTok. The slides on our presenting. If
Hello?
I stay where you are presenting, I can hear you.
Hello? Okay.
Yes, you can go
Then
ahead. If your speaker's muted, please kindly mute.
okay. Then, in conclusion, fintech is a transforming financial space. So, while they are still transforming, they have certain kinds of talent they need to sustain them. So, companies, while doing this, they need great skilled professionals to help them carry out their work. And while doing this, they should not overlook the legal framework that is supporting them. Only when they combine these two together, the legal compliance and the talents they need, they can thrive in a competitive market, they can build user trust, and they can scale responsibly. Thank you. And
All right, thank you very much to the group two presenter. Well done to you and to your team for a very wonderful presentation. We appreciate the efforts your team puts in to ensure that we had that very detailed presentation. So not to waste any time, we have two of our mentors on the call. We have Mr. Peter Cole. Thank you so much, sir, for joining. And we also have Mr. Max Ikombe on call. So what we are going to be doing right about now is that we're going to be giving the floor to them, right, to just speak to the topic and also to comment on the parts of the presentations that they heard and also based off of what was sent to them. I think we'll be starting off with Mr. Max Ikombe, and then we go off to Mr. Peter Cole to help just do a thorough work on the subject matter for today, and then we'll take questions. So firstly, Mr. Max, if you're with us, over to you. I would like to hear from you and just hear you share your thoughts with us about the legal development of fintech.
Okay, thank you again for the opportunity to be here. I can be heard.
Yes, sir, we can hear you, sir.
Hello, Dennis, confirm. Can you hear me?
Yes, sir, we can hear you, sir.
Okay. Well, thank you again. Good afternoon to you. And let me, of course, start by commending JIIPCC for the consistency in putting this mentorship program together. Let me also particularly commend Dennis and Sophie, who are always diligent to organize this and remind us and all of that. I appreciate both of you. And of course, my fellow mentor who is here, Mr. Peter, as well. It's good to share this platform with you. And I also commend all the mentees who have joined this cohort of the program. I want to assure you that the program of this nature is definitely the right way to go, because it would help you quickly find your feet career-wise and help you also locate you beyond theoretic knowledge, but also gives you that opportunity to have practical knowledge. So I'll try to keep my remarks brief. I've listened to, I apologize, of course, for joining late. I was kind of on the road, so it took me a while to get settled in to join. But I was able to listen to presentation by both groups. And I also want to commend both of you for the thorough job done in researching and putting together your presentations. I think it's very commendable. For me, I'm always full of commendations in this program, because when I look back to the time where I was still starting up in my career, on these areas like fintech, technology, law, and all, I knew next to nothing. So when I see people who are starting up at this point and who are interested in learning early enough, I really doff my hat to you. So what I want to do now is just to give you a brief overview, but I'm going to zoom out from fintech as we know it today. And I want to ask and answer the question: what is fintech? Where did it come from? Why did it come? I think it's important, because when you have that overall background knowledge of fintech, it helps you to begin to understand more clearly where the industry is headed. It also means that as an advisor to a fintech or a professional consultant to a fintech, you are able to better align what they are doing, what they are trying to do, and with the overall challenges that industry faces. So to understand who fintechs are, where they came from, why they came, you need to go back to understand the broader picture of banking, and specifically banking regulation and banking supervision. It is where you understand that you now understand who fintechs are and how they arose. So let me take you a lot back, maybe 100 years ago. When banking started, of course, we know that banking has a very old history from, the merchant systems in Italian, European medieval cities, Venice, and all of that. They already had a rudimentary form of banking, not too far different from what we call banking today, save for regulation and supervision. So closer to the relevant history, or that led to the emergence of fintechs, is first of all understand that a bank really in itself, when you break down banking to its rudiments, is simply what we call financial intermediation. That means the role of a bank in an economy is to take savings from households or from surplus units. That's people who have money they don't want to use immediately, and give that money to businesses, firms, or people who immediately want to use that money. So the real function of a bank is to take money from a set of people and then make that money available to another set of people who have immediate use for that money. So that is what we call financial intermediation, which is the foundation and the basis really of banking. So if you look at that concept closely, you see that there's a tension that arises immediately. It therefore means that if I have 1 million naira, that I'm not using immediately, and I take my 1 million naira and I give it to the bank, on the books of the bank immediately is owing me 1 million naira. But the bank takes my 1 million naira and lends it to Dennis, because Dennis wants to, do maybe a real estate construction project, and they lend that money to him. So you can see that at the same time, the books of the bank is reading that Max has 1 million naira with us. At the same time, the book of the bank is also reading that they have given 1 million naira to Dennis. But yet the bank is not saying that my 1 million haven't been given to Dennis. If I come to the bank next week and I say I want 100,000 or 200,000 out of my 1 million, they will not tell me, oh, sorry, we have given your money to Dennis. Hold on. When Dennis pays back in 2 months' time, we can give the money to you. You see that the bank will immediately make money available to me. So that tells you immediately that there's something more going on at the back end, which simply means that in a sense, that is how banks technically create more money in the economy, because the same unit of money is serving two functions at the same time. The money is still available to me as a deposit, and the money is already given to Dennis to run his transaction. So you can see that in that role now, technically, now in a sense, creating money in the economy. But if banks were allowed to do this without any form of regulation, I'm sure by now we all guess where this would end up. It simply means that the bank will take money from you, take money from you, take money from everyone, and give all the money out to business people who want to use the money. So the question is, what if the business doesn't succeed? How will the bank repay me? Assuming Dennis is not able to return the money within the 1 or 2 year period he was given, how is the bank able to repay me? So you can see immediately that some funny things begin to happen there. So one of the great dangers that led to bank supervision and bank regulation is a concept called run on the bank. So this happened in the early 1920s, before what we call the Great Depression. So what happened at that point is that, because at the end of the day, the basis on which I give my money to the bank, knowing fully well that the bank is going to lend my money to Dennis and that there's a risk that the money will not return, is because I have confidence in the bank and in the government, that is, or the central bank and the other government structures supporting that bank, that at any point in time when I need my money is going to come back to me. But if for any reason I lose trust in the ability of the bank to pay me back, what will be the instinctive reaction? The moment I start hearing rumors that this bank is about to collapse, and all of that, what do? We immediately go to the bank and demand to get our money back. But of course, the bank at that point cannot satisfy everyone, because if 100 of us had put money in the bank and the bank had loaned the money to 20 businesses, it means that at that point in time, I gave my 1 million 2 weeks ago. The bank had already given my 1 million to Dennis, and then Sophie comes and deposits 1 million today. So if I go to the bank today to get money, likely it is from the 1 million Sophie deposited today that the bank is going to pay me that. But if Sophie also comes to the bank, I come to the bank, and everybody comes back and says, give us our money today, you see that immediately there will be a problem. The bank will not be able to honor all our demands immediately. So that's what we call a run on the bank. When people lose confidence in a bank or in the financial system and decide to pull their money out of the banks, there will be crisis instantly. So because of that scenario that we call run the bank and all, part of the rebuilding of the American economy after the Great Depression included enhanced banking regulation and banking supervision. So there are many things about banking supervision and banking regulation. I'll touch just on a few of them before I hone in on how fintechs arose from all of this scenario that I'm trying to paint. So you see that one of the areas now that banking supervision and banking regulation really focuses on, and there's something internationally called the Basel Agreement. So the Basel Agreements are essentially a set of international, I'll call them meetings or summits where the central banks of different countries meet and collaborate on regulation and supervision and agree to common standards that they would use to regulate and supervise banks within their different jurisdictions. So one of the things that the regulators saw was necessary was that at every point in time, a bank should have enough liquidity, that means you have enough cash to be able to pay any demand made by depositors. So to do that, there's what we call capital adequacy ratio. That means each bank must have enough capital, enough money to be adequate to cover the exposure of deposits that it collects. Because you need to also understand that in normal scenario, when you take money from someone, technically it seems like you have gained and it's an asset. But for a bank, it's the other way around. Every money that the bank takes from depositors is added to that bank's book as a liability, as a debt, because that is money they must pay back. So what capital adequacy ratio and the other regulations and around banking, part of what we call the Basel III Convention, is to ensure that banks always have adequate liquidity. So You have things like capital adequacy ratio. You have things like what they call them now. Sorry, I'll get the name and I'll mention it. But by and large, all what those things do is to ensure that at every point in time, the bank has enough capital, enough money to meet its demands from its depositors. So because of all of that, banking became a very expensive business to do, because for you to run a bank, for instance, at the moment you need to have, I think currently in Nigeria it's about 45 or so percent capital adequacy ratio, and then there's also part of the minimum deposit that as a bank you must keep with the central bank. So it means if you are running a bank, I mean, most of you would have heard recently that the central bank has increased the capital base for banks to, about I think about 500 billion, and all the banks are looking for money to raise their capital up to that standard. So what it just tells you is that banking, because of the dangers inherent, things like run on the bank that I mentioned and all of that, is a very expensive business to run from a regulatory point of view. You have to do a lot of compliance, there's supervision, there's so much money that banks spend just on complying with regulations and laws. So because of that, not every Tom, Dick, and Harry can stand up and start a bank because of the kind of money you need to have available to start a bank. So it is out of that a need now arose, that it got to a point where banks were too expensive to run, and the few banks were very inflexible. They were not meeting the demands of of the banking public, because they had to comply with so many requirements and regulations. I mean, for those of you who, but a few years ago, getting a loan from a Nigerian bank was totally impossible. They asked you for all kinds of things, unending requirements, and all of that. These were all the result of regulation and supervision of banking. So earlier on, somewhere around the 70s or thereabout, in the US, a lot of companies started coming up with innovative ways to actually engage in banking business without carrying the heavy regulatory cost of getting a banking license and running a bank. So that is the forerunner of what we call today fintech. So another terminology I want to introduce you to, which really is where the birthplace of fintech is what we call regulatory arbitrage. Regulatory arbitrage simply means a way to leverage gaps or loopholes in regulation to enable you carry on a business activity that you will be carrying on in a way that you do not have to comply with the full weight of regulations at the same time without breaching the regulations. Of course, if you choose to open a bank without a banking license, simpliciter, you'll be violating the law, you'll be prosecuted, you'll be arrested and sent to jail. And of course, your assets will be confiscated because you have breached the regulation, or the laws governing banking. But people now sat down and read the law on banking carefully, and I said, look, we can look, there are some things that the law does not say in black and white is right or wrong, but I can do them and still offer banking services without having to have heavy capital base, without having to go through all the regulatory requirements that banks fulfill. So that is where fintech came from. That's what we call regulatory arbitrage. Looking at regulations and finding gaps in between that you can use to build a business model along the line. In the Nigerian fintech space, for instance, we have a lot of common examples. One of the regulated businesses that you cannot do, for instance, is lending. Lending is reserved by law for banks, and for banks even themselves to lend, there are so many requirements they have to comply with, which makes lending expensive. But a clever fintech can sit and look at the different laws and say, well, there's the CBN Act and the Banking and Other Financial Institutions Act, both here, that says only banks can engage in lending, and that even for banks to engage in lending, they have to fulfill so many requirements. However, if you read closely, those laws do not stop you from operating under the license of a money lender's license issued by the different state governments. So you can see that without breaching the law on lending, you can take a money lender's license. But what happened was that the money lender's license law was written at a time where there was no technology. So the expectation of a money lender's law was that a money lender is just a small business that is based on the street and that its customers are only from around its immediate vicinity. But with technology now, it means that I can get a money lender's license in Maiduguri, Borno State, and I don't have to leave Maiduguri, Borno State, but I can put my products on social media, and people in Lagos can patronize me. People in London, and everywhere can patronize me. So you can see that using that technology now without breaching the law have suddenly begun to do what only a bank can do, which is lending on a large scale, yet I have not breached the law. So I hope you can see how regulatory arbitrage is the birthplace for most fintechs. So most fintechs started on that, looking for gaps within the regulations where they could carry out regulated activity without carrying the heavy cost of regulations that come with them. Of course, the system is never static, so the government is also alive. So what ultimately happens is that when the government sees that people are beginning to find gaps around the regulation, they begin to close those gaps and make new regulations. However, what governments now saw was that there was another, another significant benefit that fintechs brought to the table. Every government wants financial inclusion. They want to make financial services, democratized and available to people of all strata in the society. The traditional banks can't do that because of the cost of running their business. It makes it unattractive for them to also cater to retail or the lowest levels of society. So because of that, the governments have now realized that if we simply close all the gaps in the regulation and we force all fintechs to become banks, then we'll end up not fulfilling our financial inclusion target. So because of that, that is why governments are now making bespoke or tailor-made regulations to govern fintechs. But what you must know, and this is what I say whenever I advise fintech clients, is that ultimately the same dangers that made the government create such tight rules and regulations around banking will catch up with you, because the moment you begin to handle money at some certain levels, then for the good and the benefit of the society and everyone, certain regulations have to be in place to ensure that you do not misappropriate all of that money put in your trust. So that simply tells you that as a person dealing with fintechs, what we must expect at this phase is that regulation around fintechs will continue to increase as adoption of fintechs and the growth in the industry increases. So that those two things will happen together at the same level until we get to a point where there's going to be a new wave, of fintechs again that would have to come, find gaps in the regulations, and then build lower use case business models. And then, of course, as they grow, invariably you will attract to yourself more regulation. So I thought it was important to just lay this foundation so that whenever you look at the legal development, of fintechs in terms of regulations and all surrounding them, you have that background that there is always a target, but the government is trying to balance two interests here. How do we ensure safety, but at the same time, we also want to ensure that financial inclusion happens at the same time. So that always is the balance. And for a fintech that is going to win in the market, you have to hit that. You have to strike that balance, in an optimum way to ensure that you are delivering value to customers, but in a way that is safe, is secure, and that satisfies the government's drive for financial inclusion. So I just thought to give this very, overall background to your learning in this area. And then, of course, as we keep going in these sessions, I'm sure we'll be able to engage on more direct questions. And also, thank you all. And Dennis, back to you.
All right. Thank you so much, Mr. Max, for a very, very wonderful start to this session. You were able to give us an overview and a history into fintech developments and how fintechs came to be and the background for the legal requirements for fintechs that they use to start operations. So Mr. Max has done a very wonderful job to give us an introduction into today's topic. We have Mr. Peter Cole to carry on in that light, to also share his thoughts, and also give us a more detailed, in-depth approach into the legal development of fintech. So we would like to hand over to you, Mr. Peter Cole. If you are with us, please, the floor is yours, sir.
Good afternoon, everyone. Thank you very much, Dennis, for introducing me. And a very substantial part of my appreciation will be to Mr. Max Kongwe, who just lead a very solid and robust overview of the legal development of fintech and that interwoven nature of how law applies to fintech. It was a very enlightening session, and personally too, even though I'm a mentor here, there's a lot I've taken away from the session you just gave. I mean, of course, it's a senior learned colleague at the bar, and there's always a lot to learn from people like him. Also understanding that he runs a thriving practice that advices on ICT and tech primarily as well. So once again, thank you very much, Mr. Max, for that very enlightening and insightful session you just took. Once again, I want to start by apologizing to the JIIPCC team for, like I mentioned, I had a bit of a scheduling error. I thought that this session was scheduled for next week, but unfortunately, I did realize after I got a reach out from team members, Sophia particularly, that it was today. But notwithstanding that, I have listened to two different presentations and a part of the first one and largely the entire second presentation. And just like Mr. Max pointed out, there was a lot of laudable and applaudable part of the presentations that I would like to just commend once again. One is the research. There was an obvious display of research from the way the presentations were tailored and then the way they were designed and presented as well. So I want to congratulate and also to commend all the presenters and the team members as well for a job well done in that regard. Also to see that in terms of the extent of your research, we were able to see a balance of one, an understanding of the fintech ecosystem in Nigeria, how it has evolved over the years, and also that was done without downplaying the necessity of balancing the legal framework as well. And you notice that the extensive time that Mr. Max spent on breaking things down was just to primarily ensure that we all see the necessity of one, playing by the rules, but also being very not the word is not crafty, the word is more of being intentional enough to be able to identify perhaps one is loopholes or possible gaps. Yeah, that's a more specific word in that regard. And these gaps are vital for the business of fintechs. So the idea is that when you play in a system like this, you're either one, a very highly funded business that is able to meet any requirements, or two is even if you are bootstrapping or you are very you are very low funding, that should not be a limit to what that business can still achieve, because you need very vital legal advice from experts like Mr. Max and other players in the ecosystem who can tell you where to look out for and then to be able to plug yourself into that. But more specifically, in terms of the framework of legal development around fintech, I think one other part of the discussion that we could also explore is the approaches and development around how that's, for instance, now the issue of funding. Now, this is vital because, as we know, the business of fintech itself, or fintech as a business, is more or less something that is highly dependent on some significant pool of capital, because if you're offering to even obtain a license in the first place, right? I'm sure almost all of us are aware of the rigors around it. If we're not aware, Mr. Max did point out that CBN, being the primary regulator in that system, for instance, oftentimes churns out some specific requirements that regulators have to, that the market service providers have to meet and comply with, and that's why gaps such as licensing or sub-licensing, or someone asking to use an existing license in that system comes to play. But beyond that, in terms of funding, for instance, we've seen a more recent stride towards lower funding for the Nigerian and more or less by extension the African ecosystem. This is probably tied to a bit of, policy, right? Global policy framework changing. For instance, in the US, since Trump came to power, there's been a radical shift in the approach around funding globally, and then the whole, USAID connection, for those who are aware of how that interplays, and that has affected the ecosystem. But substantially, in terms of numbers, what has happened is, for instance, in 2023, there was up to close to 900 million USD in investment in fintech startup or fintech ecosystem, investment of up to almost $900 million in the Nigerian space alone. However, in 2024, there was like a significant reduction in that value, because the total value up to the close of the year was almost about half of that figure. So it shows that over time there's been a sludge or a reduction in that. But notwithstanding that, what is vital is that the players who play in that system have been able to find and devise means one is to build a sustainable product, and two is also to understand the interplay of the regulatory oversight vis-a-vis the need to build products that are innovative, right? There was a mention of the data protection angle to things, which I also found very interesting in the presentations that we had. Because if you, for those who are familiar with the legal news around, a couple of weeks ago, the NDPC, that's Nigeria Data Protection Commission, released a list of defaulters who had not complied with certain data protection tenets, and several of them were also fintech companies as well. And the intent was just to point out that these are strict regulations that any serious organization has to comply with. So even if you are building innovation, you are engaging in products that will help to bridge the gap between the unbanked and the banked, as many fintechs like to say, all of that. These are very vital as well. But that balance between regulation and innovation has to be struck. And how do you do that? It's by a solid, a legally focused and a business savvy regulatory compliance. So it's more of being able to engage legal minds who know the law, but also know how to apply it in a way that is applicable and that is helpful to a business, right? Because of course, being legally savvy is one, being business savvy as a lawyer is another thing. So that balance has to be struck. And you having had that extensive feel from Mr. Max, I'd just like to say that there's a lot to still more or less unbundle and unpack as far as that is concerned. But more importantly, we've had very insightful, very helpful, and very engaging presentations from team members. And there's a lot of takeaway points. In terms of recommendations, I like to say that when you're focusing your research on something of this nature, it's also important that you look beyond just the entirety of the legal framework alone, but also focus on one in terms of the investments that are flown into the ecosystem, right? And also recommendations. There was a particular group that did talk about recommendations for how things can be improved in that nature, and I like that particularly. So if that balance was struck as well, that would make for a far more interesting and robust presentation than it was. But that's not to take away anything from the presenters. I once again had a very great time listening to you guys, and I'm sure that Mr. Max also said again, quoting his words, this is not the ending point. Like they say, some like to say that the sky is the limit. Some others like to say that the sky is just a starting point. For me, right, there's no limit to what you can achieve in the space as long as you set your mind to it. And we are conscious about one, knowledge building and self-development, and two is ensuring that one, not only do we understand what it takes, but we also understand the connectedness between knowing and knowing how to apply what we know, essentially. So once again, thank you very much for having me. Mr. Dennis, over to you.
All right, thank you very much, sir. Thank you very much, sir, for sharing also your thoughts. We really, really enjoyed your thoughts that you shared with us from both mentors. They did a really good job to give us an introduction into what we'll be discussing and how the progression of our discussion is going to flow from here on. So continually from after here, right, after this particular class, moving on into week 2 and week 3, I will build up on more practical things to discuss on within the fintech space, and what is totally encyculated within that industry, right? So we'll be having some of our mentors come back to us in subsequent classes, and they will be sharing their thoughts on other topics and other aspects of the fintech industry, that relates to you knowing what to do when engaging with either a client, or you are actually trying to build a fintech startup, and some of the things that you need to know if you want to establish, whether if you are also an enthusiast and you want to find out what is happening in this space. I'm sure our mentors, like they started in today's class, will be able to give you this continuous kind of information. So not to waste any time, we'll be taking questions. We'll be taking questions from the mentees. I'm sure it has been quick, very quick, but it has also been very, very detailed within that sense. Their presentations have been very, very detailed, right? So please if you have any question in the small time or in the short time we've spent in class today, and you would like to ask, please do well to um, ask your question. You can do so by the raise of hands, or you can send your questions into the chat box. Okay, I can see some questions here. Okay, I'm coming. I'll be reading them out. All right, these are questions from group 2. Okay, group 2 is asking that, okay, what are the major, sorry, I'm coming. Let me try to get the questions so that I can read them. All right, so the first question from group 2 is, what major challenges do fintech companies in Nigeria face when trying to hire skilled workers while also meeting regulatory and compliance requirements? And then the second question is, what practical steps can young professionals take to build a career in fintech law and compliance, considering how fast the industry is changing? So I will leave this more like an open question to both mentors, right? Depending on how comfortable you are answering any of them. So I'll be giving an open floor to the mentors to try to tackle the questions that were sent in by group 2.
Okay, thank you, Dennis. I think I would let me take question 1. I think this question 1 flows along with the presentation from group 2 in terms of the challenges when trying to hire skilled workers, and also meeting regulatory and compliance requirements here. So it's a major issue here, and it comes back to some of the things I discussed in my earlier intervention. That so I mean, among the supervision and regulatory oversight in the financial sector by the CBN is also about what we call fit and proper person criteria. So as a bank or as a fintech or any entity regulated by the CBN, it's not just anybody you can appoint into certain sensitive positions in your organization. For certain people, for instance, at your C-suite level, your managing director, your chief financial officer, and the different chief officers, you might need, for not all of them, but for some of them, you need a clearance from the CBN. There's also some other rules that fintechs particularly also need regulatory cover on. For instance, your DPO, your data protection officer, those are things that also have regulatory requirements around them. Now, coming down to practical experience, part of my practical experience I've seen, advising fintechs in the area of recruitment, really, borders around things like mobility. So we all know what's happening currently in the country, and for a fintech based in Nigeria, a lot of times those fintechs simply just become training breeding grounds. The moment you get your people, scale them up to a certain level, and they have a certain level of experience, instantly the man is getting an offer somewhere in Canada or somewhere and is running away. So that also is a challenge because it creates a lot of turnover within the organization. It also means sometimes that the organization has spent a lot of money training, investing, giving opportunities to that person, sponsoring him to attend, events, to brush up and to get him up to speed. And immediately he gets up to speed, he leaves. And then the organization has to grapple to start getting new employees all over again. So personally, from my viewpoint and from experience, there are a couple of approaches we have used that really works, to retain the relevant personnel in a fintech company. So one of them is, there are two broad things under the same head, but essentially incentivizing loyalty over the long term. So one of the ways you do that is that for key officers, you might enter into a vesting agreement with them or an employment agreement with a vesting schedule. So what that means in practical terms is that you get somebody who's very talented, your chief technical officer or your CFO, very talented, who already has who clearly you can see has some future. But because you do not want that scenario where he immediately starts working with you and he gets to a certain level, he leaves immediately. You can agree to give shares to the person on a basis that it will vest over a period of time. So the very plain vanilla type vesting agreement is a vesting that is done over 4 years with a 1-year cliff. What that simply means is that you can give the person, say, 4% of the equity of the company, but that 4% will not belong to him immediately, because if you give him that 4% immediately and tomorrow he leaves your company, he still owns the 4% and you no longer have his services. So to avoid that, what you do is that you vest that 4%. So you give him the 4% potentially with the agreement that 1% will vest for each year of completed service. So after 4 years, he will now own all 4%. So that way, you are guaranteed to have his loyalty for at least 4 years. That's one way to do it. Another way to do it is to, rather than use time frame, you can use performance markers. So the person is your CMO, your chief marketing officer. You can enter into a vesting agreement that says, fine, when we launch our mobile app version, if it hits 10,000 downloads, you will get 10% of your total equity, which will be 0.4%. When we hit 100,000 downloads, you will get 50%, which will be 2% of your equity. Sometimes you can do a hybrid where you say, if you stay for 4 years, you can get your equity vested 1% per year for the 4 years. But you can now add that if you hit certain performance milestones, then there'll be a trigger where where you get quicker vesting of the shares. So that's one way to do it, to ensure that you are recruiting someone, but at the same time, you are also you are tying them into the overall performance of the company, because beyond only keeping the person's loyalty, the person also knows that if I can make this company grow from being a 100 million naira valued company to 10 billion, it means that my 4% instantly jumps from I think that'll be from 4 million to from 4 million to 400 million. So you can see that it creates an incentive where the person is really incentivized to stay longer with you and also to contribute to your growth. Another approach also, apart from individual vesting, is that you can do what we call an ESOP, an employee stock option plan. There are many names for it actually, but they all mean the same thing. What they all mean simply is that you reserve a certain amount of the stock of your company, typically between 10 to 15%, that you now give potentially to employees on the condition that the employees are given the shares, they pay for the shares at a fixed price or at an agreed price that is usually below the market value for those shares. So the idea being that if you give them the shares and you say, look, you can get each share for 2 naira, but by the time they are coming to cash in on those shares, maybe after 5 years, the value of the company has gone so high that each share is now worth 5 naira. So you can see that the person has made a significant increase. So he's only paying 2 naira, but getting shares worth 5 naira that he can sell. So that way also is the same incentive system I mentioned earlier. You are making the people interested in growing the value of the company, because as the value of the company grows, so does the value. You can see that these two models, to a mutually beneficial dependency, where the people with the company know fully well that they are continued loyal to a mutually beneficial arrangement. Another way also, to also secure or protect a fintech within of this is that you can make it clear also, you can also do what we call a bonding agreement. That says maybe you have some regulatory qualifications for that role, and I sponsor you for the trainings, say a data protection officer, and I sponsor you to get your CIIPCC, that's European data protection certification, and maybe I spent 5 million naira doing that. you do a bond agreement and make it clear that in reach is 2 years. And if he fails to work for 2 years and that money, so that I can use that money to sponsor Nigerian law on them, servitude for too long. So averagely, 2 years is about the maximum that you would ever get a court approved for that kind of agreement. So you just need to be careful the person for as long as 2 years. So these are just some of the ways you can maintain that challenge of retaining and loyalty and that long-term benefit from the recruitment and from what you have spent in upskilling and upgrading. Number one. Thank you, and back to you, Dennis.
All right, thank you very much, sir, for your thoughts shared and for helping answering that question. Okay, I think I'll be directing the next question to Mr. Peter Cole. The second question is, what practical steps can young professionals take to build a career in fintech law and compliance, considering how fast the industry is changing?
Thank you, Dennis. So just to again say that Ms. Marks in his answers already sort of did an overlap into more one very vital thing that can help build your portfolio in terms of showing competency. He had talked about the very popular certification, which is the CIPP, more related to data protection. But just understanding that as it is now, there's no specific unified certification for fintech in itself, as far as I know. However, there are some frameworks around compliance. Now, one very popular compliance certification you could look into. But then the challenge is that, I mean, a lot of this very key certifications costs quite a bit, right? So it might be limited or limiting for someone who's just starting off to be able to afford the fees it would take to maybe get a CIPP, for instance, which is the certified, more or less a data protection experts on either European law or the US American system. As far as Nigeria is concerned, recently we now have a unified and also a body that is recognized by the NDPC, which is now responsible for issuing certifications on proficiency in Nigerian law. That's the Nigerian the Data Protection Academy here in Nigeria. So I think they are still cost a bit. So if you cannot afford CIPP, for instance, or CIPP US, you could just go for that the Nigerian Data Protection Academy guys and get a certification that will probably cost you the most between 50 and 100,000. Now, if that's still a reach for you, what you could also do is, I'm sure there are a lot of, for instance, now more recently, given the drive in the legal space for CPD points, we now have a lot of trainings for the lawyers here. Sure, not everybody is a lawyer, but for the lawyers, there are a number of trainings. I've seen a couple of them more recently on either fintech or data protection that you might take up on a free basis and then just earn the certificate. And also, even this particular session we're having in itself, as far as I'm concerned, is a valuable way to show that you have attained some level of knowledge, even if it's not an experience or competency per se, but it will show that one, you have an interest in the space enough to have taken a training on it. So this certification that you will get from JIIPCC does matter as well. That's a start in itself. Another thing you could do is look out for courses that are free. Now, I'm trying to look at it from the perspective of someone who might not be able to maybe afford the usual fees it would take to get an ACAMS. That's a popular compliance certificate. That's a certified anti-money laundering specialist certificate, which is more or less tied to fintech. You know, when it comes to fintech, there are always a lot of questions around KYC and also AML and CFT. That's anti-money laundering and counter terrorism funding per se. Now, so at this level, you might want to look out for courses that will allow you to, that you'll be allowed to take for free and also earn the knowledge while also earning a basic certification. At that point, nobody's going to be asking you for the more advanced courses, which might then be a question of what you have in that sense. So, but if for instance you are able to afford certifications, these are key certifications you could look out for to take as someone who is very interested in being a compliance officer or being a fintech legal advisor. Because even if the knowledge is very important, and I'm sure that's what is that key knowledge and that experience of having advice in the space that's very key legal advisors are able to portray, which is even more important than even perhaps certification. Another thing you could do is, I'm sure you have friends who have a couple of maybe startups they're running in that space as well. You could have an arrangement where you volunteer your services to work with them at the start. And thankfully, if they do raise some substantial capital, as I was privileged to have in an instance, for instance, I sort of joined a startup at bootstrapping stage. And then when they did attract investment, we have to review the terms of engagement, right? But that experience I had with advising them was very helpful, and it's something I will forever be grateful for. So that's another way to more or less build and grow competency in that space. Aside for in an instance where the certification courses might be quite very pricey or out of range for you due to the prices involved. But if they're not out of range, why not go out there and be strategic about what you want? So if the idea is you want to build competency and certification in that space, CIPP is a vital one in data protection, which is also a very key component of the business of fintech, because a lot of that involves personal data of users, personal data of either third-party agents, anyone, a service provider in that space that they work with. So that's also very important as well. Just tying down to another question here, I think we talked about certification as well. And in terms of certification, of the internships available, both international and local, for someone who is interested in fintech compliance. I think I've touched a bit on that. You could also more or less, like I mentioned, focus on early growth startups that are fintech oriented, right? Maybe if you, for instance, took interest in one of the number of hackathons here and there that happen almost every time now. CC Hub does. They have this fintech accelerator program that they do like on an hour basis where people come to build products around fintech. That's a space to find those young talents who are at that point have not even raised enough capital or already built a brand like MoneyPoint or OPay, because of course these are brands that also started maybe small at some point. I mean, okay, tell me, OPay didn't exactly start small anyway, but of course MoneyPoint reasonably did, right? So in any case, you don't know whether you're looking at the next MoneyPoint, perhaps, or you're looking at the next Pampy, maybe. So you could consider looking out for such opportunities to volunteer your skills. It could just be an opportunity to just learn something new. And in terms of internships, right, I'm not particularly sure of any structured framework for fintech legal internship as a way now. But I know a number of the firms now, the typical law firms you'd advise, you'd apply to work with. Now, for instance, now Mr. Max here heads a law firm, and I'm sure because ICT law is a key advisory practice for his firm, maybe you might also want to put Everlaw as one of the firms or one of the outfits you're applying to for fintech internship, so you can learn a bit more about that. Yeah, so that's as far as that goes, generally. And more importantly, like I said, build knowledge, because every time you talk about something you say is important to you, one of the things people will always see from the way you talk about it is whether you have one, knowledge, and two is how much of interest do you show in the way you talk about it. Because if you truly are interested in something, then you would have taken your time to read about it, read about the deals happening around the fintech space, read about the entirety of what it takes to get a license. That licensing procedure is very vital. If I were to meet you today and you talk to me about just basically the licensing procedure of fintech, it would go a long way to prove that you are not just someone who thinks it's a what's the word, potentially money blooming system. You're just someone who really does want to advise in this space. So build competency, build knowledge, and more importantly, if you can't afford certifications, the key ones, if you can't, look out for the free ones. There are free ones out there as well. So I guess that's more or less interpolate the couple of questions around internships and certifications. Thank you.
All right, thank you very much, sir, for helping us run through that question and also answering the next one. I think the last question we have here is, please, what is the recommended equity split for a fintech? Mr. Max, do you have an idea into this particular question?
Okay. Yeah, I'm trying to see, is that question, okay, what is a recommended equity split for a fintech? That's interesting. I'm sure, of course, maybe Mr. Peter would also give some context on that, because these issues are not, is not cast in stone, really. It's about negotiation. But however, because we know that most fintechs usually go through the regular private equity venture capital route and all the fundraising rounds, to an extent, there's largely an almost increasingly growing uniform system that you have to use, because we know that the funders usually request or insist on certain things. So one of the things I know is that typically before you're at Series A funding, they might not insist, but typically at the level of Series B and upwards, where you are beginning to raise significant amounts of money, most funders are going to insist that before their money comes in, because there's what we call pre-money valuation and post-money valuation. So usually what they want to do is that before their money comes in, they want to ensure that you have set aside a significant amount of equity for your employee stock option pool. So usually that's where the figure I quoted, 10 to 15% comes from. Some, depending on their due diligence on your business, might insist that set aside as much as 25%. The reason they do that before their investment comes in is that they don't want their own equity to be diluted by the stock options. So they want you to have taken the hit for granting shares to the stock option before their own money comes in, just so that when their money comes in, they are not taking any dilution from having to give out shares to the employee stock option. So usually that leaves somewhere around about 85% of the shares which is left. So again, it would depend on what stage you are. Of course, another vehicle that most fintechs use to raise money is because again, we know many fintechs, because of the ones at least who are targeting foreign private capital equity investment, will do typically what we call a Delaware flip. A Delaware flip is simply a system where you incorporate an international holding company that takes ownership of the company, the primary company itself, and then at the level of that holding company, the equity split is done. So let me just break that down to make it simple. So you already have started, you have established a startup here, you are doing reasonably well, you have gotten some level of angel investment and all of that. And then you are beginning to get to a point where serious private equity or venture capitalists want to come in. Now, they don't want to come in and take shares in your Nigerian company because they have a lot of concerns. One, they know that Nigerian law can have a lot of trouble, the courts can last forever and all of that. So to avoid that situation, they ask you to do a flip. So the flip simply means that you incorporate another company, usually in a jurisdiction that they are comfortable with. We typically call it a Delaware flip because most of them insist on the state of Delaware in the US, but it can be done through a holding company from Singapore, Mauritius, Dubai, Caymans. It can be done really anywhere, but the principle is the same. So if at the level of the company, let us assume that after their money comes in, both of you agree on a 60-40 split. That means they take 60%, you take 40%. They don't want to come to your Nigerian company and take the 6% of your Nigerian company. So rather you incorporate a company in Delaware or in that foreign jurisdiction. That company now buys 100% ownership of the Nigerian company. Then your 60-40 equity split is now done at the level of that company in Delaware. So what it means is that if the company in Nigeria makes 100 million, that 100 million would, on paper, belong exclusively to the Delaware company. So the 100 million is theoretically taken to Delaware. Then it's at the level of Delaware now that you take 40%, they take 60%. So that's what that flip is all about. So I was just making that point to say that another way that most companies who are eyeing fintech startups who are eyeing foreign or private equity and venture capital, another usual route, another usual instrument that is to raise money is what we call a safe agreement, a simple agreement for future equity. I suspect that one of your further modules, you'll go a little bit deeper into that, but a safe agreement is simply an agreement that balances equity and debt financing in a very beautiful way. So, of course, you need to know that as a fintech startup, the owner of the fintech startup, he wants to retain as much control of his company as possible. But the issue is that he needs money. So if you are going to bring people's money into your business, you have two options. Either you bring in the money as debt, in which case you retain control of your company. So you can own your company 100% and take a loan and pay back that loan with interest. But because in the fintech space and startup space generally, there's a lot of risk. You are not a big company yet. In fact, nobody's going to even give you a loan because you don't have enough assets as collateral. So that is even difficult to raise. But even if you were to raise it, it's very risky because if your venture goes bad or your venture needs more time to raise money, the bank or your borrower is not going to wait to hear that. He will foreclose, close down your company, sell off assets, and recover his money. So, of course, the other way to raise money, if you don't want to go the route of debt, is to use equity. Equity means that you give people control of the company in return for their money. But again, that now dilutes your control over the company because imagine if your company at the point you have started is valued at 100 million and you need an investment of 5 billion, for instance. It means if somebody brings 5 billion, already that person owns maybe like 98% of the company or 99%, and you own 1%. So because of that, it's safe agreement, simple agreement of future equity. It's an agreement that is structured such that when you take the money is taken as a loan that will be what we call a convertible loan, that it will convert to equity at a future point in time. So the reason being that if you take the money today, when your company is valued at 100 million and you took 5 billion, and it is to be converted to equity in 5 years' time. If in 5 years' time your company is now worth 20 billion, that 5 billion would therefore only be 1/4, 25% of the equity in the company instead of being 98% if you are taking it as equity immediately. So that's also a clever way to balance your equity and debt capital and convert what was originally a debt into an equity as you go along and convert to an equity at a time where your valuation is high enough to absorb that equity without making you lose too much control. So with all of this I've said, now the direct answer to your question is that there's no hard and fast rule on on how the equity split in a fintech startup is done. It's usually subject to negotiation, but some of the things that are going to that negotiation is that you must have enough equity reserve for your employee stock option. Of course, you want to typically ensure that as the owner, you do not lose more than you along with the equity, your employee stock options do not have less than 51% of the shares. So it means ultimately that you are trying to retain, at least for yourself, at the level of the founders, the co-founders or the founders, at least 30 to 35%, 35 to 40% of the equity, and then you give the rest to you give another 10 or 15 to your stock options, and then the rest is available for external investors. Sometimes it could be the angel investors, the first set of people, some of the key personnel you engage at that point, you give some of that equity, and then of course when more money comes in, you dilute and try to create new equity to bring more people on board. So it's not a question that has a hard and fast answer, but it's something that a lot of things are taking into consideration. Your strength to negotiate, the strength of your proof of concept, how far you have gone. If you already own patents that are very valuable and all, then it means you already have enough bargaining chip while you are coming to the table to agree an equity split. So equity in fintech actually can be very complicated. So there's another concept, what we call a cap table, where you now have to start plotting the graph of everybody that owns equity, the stock option people, the angel investor you gave equity earlier, and then maybe you had agreed that when money comes in, his equity will be diluted, to a certain proportion. So it can be quite complicated to work out a cap table, but that's part of the role of a CFO in a fintech startup, to be the person in charge of the cap table, monitoring it at every point in time and ensuring that the level of control that the founders need is always maintained as they continue to create and give out more equity. So thank you. I hope I've answered that question. Thank you.
Thank you so much, Mr. Max, for sharing your thoughts with us on that question and for giving us a very detailed breakdown into it. Thank you to our mentors who have done so good a job in addressing questions and just sharing with us based off of professional experience, right? Things that you will not necessarily get in any classroom or in any textbook, apart from being in a circle where professionals are speaking, right? So we'll be taking one last question and we'll call it a day in today's class. And that question is, other than the data protection and compliance advisory rules, what other rules are available in fintech for young professionals, especially lawyers?
All right.
Mr. Okay. Yeah, you can go ahead, sir.
It's called me anyway. So, all right. So once again, thank you to Mr. Max for the very well-rounded answer I gave regarding that question. I was preparing to maybe make an addition, but that answer substantially covers everything reasonable, foreseeable. The other addition is just that when it comes to the angle of within the startup itself, I mean, you talked more about external funding and how your startup can sort of restructure your equity in such a way that you're not losing ground or losing control, because control is always vital. But again, there's always this saying that 100% of zero is zero, right? I mean, even if you own 100% of everything and you are doing protectionism, as opposed to more recently, those familiar with the entertainment space would know that there was a recent development with Maven Music, Don Jazzy and his co-founder who sort of opened up their investment, and they substantially gave away a percentage that leaves them in a minor control of that organization, but puts them in a better position overall, reasonably speaking. So it's always a question of what's most important to you as a startup founder, and what would you value more? Do you want to retain substantial control without a corresponding value in, as opposed to if you were to, what the likely implications would be if you get off that control? But at the early stage, when you're still at early stage funding and let's say you're at pre-seed level, it's always also very important that you ensure that even if you have a group of co-founders, the cumulative set of the equity investment you have in that company that you own is substantial enough to keep you in a position such that no external investor or external body can kick you out early enough, because it then means that you are more likely to be put in a position where you lose everything you have in terms of control and in terms of building that vision you have in mind. Quickly to that question of the career roles, I think that one aspect of it is to talk about potentially the other. It's also very tied into conversations we've had thus far on the issue of VC, venture capital, private equity, who are more likely to invest in fintechs. So either as a legal mind or as a non-legal mind as well, because this is a career path open to both legal persons and non-legal persons. But someone who is interested in both finance and that intersection between finance and technology, venture capital, private equity advisory is a space you could look into, right? Because it then means that you're able to first advise on startups, understand the space, the startup ecosystem itself, and also understand what funders to look out for, understand what potential startups to invest in, and then overall, there's this particular program called JIIPCC. I'm sorry, maybe a couple of us would have seen it. It's an avenue that allows you to learn the rudiments of venture capital investment and funding over time. So if you were to get into an academy like that, there are a couple of them out there as well, who give you a platform to learn and grow and develop into an investment. So you would more or less technically become an investment advisor into the startups, primarily the fintech space and all that. So that's also an angle to look at it from, aside from just compliance or regulatory legal constraints, as it were. But of course, as a legal mind, you could also directly work hand in hand with these startups to either be another path could be to be the legal officer for startup companies, advising on everything related to negotiation, review, and finalizing of legal documents pertinent to the work of a fintech company. Part of it is also an advisor on M&A deals and everything related to raising capital, how the company grows, and how you attract talent and retains talent as well, and overall everything regarding the business of that fintech. But extensively, we've also heard from Mr. Marks, more importantly, about what it takes to be well-rounded in that space, which is primarily ensuring that you have a key understanding of the dynamics of one, not just the business angle, but also the legal interplays at work there. Two is ensure that the interest of the startup is reflected in either the advisor is giving, but also the structuring of how a deal or a potential investment is approached, right? Which still take us back to the issue of when attracting capital, the issue of a pre-valuation, pre-funding valuation, and then post-funding as well. How to make that balance in a manner that ensures that you have a valuation that meets the market demand, but also ensures to keep you in a key control position as a startup that's looking to a fintech startup that's looking to attract investment, but more as a legal professional in that field. There's a consideration around the rules you want to look out for, and also opportunities to grow. As I mentioned, other fields outside of that, but that still interplay with fintech are key, not just data protection alone or compliance, but also you could venture into the field of venture capital, private equity advisory, or other spaces around that. I hope that answers the question.
Thank you very much, Mr. Peter Cole, for also helping answer that question. Our mentors have taken quite a lot of time to, help answer questions, and also, sharing their thoughts and still expanding more based off of, both the questions and the subject matter of the topic for today. We want to say a special thank you to them for, their knowledge that they have contributed to this particular session. We have come to the end of today's class, but just before we go, right, it's almost raining in my location, so my background is quite very dark. But I want to ask that, for those who for those who have proper lighting in their background, please can you kindly turn on your videos so that we can take a quick screenshots of, picture frame for today's class. We'll do that quickly and then we'll call it a wrap on class. Right, so please, if you can turn on your videos so that we can take a quick screenshot and call it a day. Thank you very much. Please, can we have more people turn on their videos? All right, thank you. All right, so we are done with that. Thank you everyone that complied. Right, so moving forward, we will be sending you a new task for the week later on. Hopefully, well, between today and tomorrow, you'll be receiving a new task for the week. And please, I want to encourage all of us that just like the way we put in the effort to work on this particular presentation and our different articles, we should put the same efforts entering into week 2. Right, the knowledge is progressive and it is building line upon line, building upon building, block upon block within that sense. Right, so please let us commit to the process. Knowledge only gets better, the awareness only gets better, and overall the things to learn will only get better, right? So commit to the process, and I'm sure it's going to be worth your while and worth your time. So moving forward, yes, once again, a big thank you to Mr. Max and Mr. Peter Cole for their spared time and knowledge in our session today. We are really, really happy to have both of you on the call. We look forward to having you in subsequent sessions, right? To look forward to having you in subsequent sessions. Look forward to having you in subsequent sessions. Also share your knowledge and your thoughts with us. Thank you, everyone, and have a lovely evening. Goodbye.